Respected Shri Pinakin Desai, office bearers on the dais, attending BCS past presidents, BCS members, and fellow attendees. A very warm welcome to this public lecture meeting on direct tax provisions under Finance Bill 2025. This year's budget has generated high decibel positive reaction owing to the unexpected generosity in income tax slab rates under the new regime, with the corresponding rebate provisions as well. The reaction is perhaps amplified in our city of Mumbai, which has the highest number of individual taxpayers. And from the next year, it is estimated that Bombay will have 50% of the individual taxpayers, effective taxpayers, given that the slab rate is then at a much higher number. The first full year of Modi 3.0, the fancy in the budget seems to be for enhancing consumption rather than the hitherto push of creating infrastructure. 10 years before, when the first budget was announced under the Modi government, the infrastructure spend was at about 2 lakh crore rupees. After 10 years, we are annually spending at about 10 lakh crore rupees, 5 times jump in 10 years. In comparison to that, the slab rates for a basic tax-free kind of a number had only grown 2 times over the last 10 years. A good catch-up has been done this year in terms of having the slab rates and the rebate also at corresponding speed. I was told that the enhancement or the foregoing that the exchequer has done on account of the slab rates is at about 1 lakh crore. This can certainly have a big impetus to consumption. It is also expected that a lot of people from the old tax regime might shift to the new tax regime, thereby freeing up from the requirements of forced savings or saving in some particular instruments which used to give that benefit, and thereby having discretionary in terms of spending there as well. All of that, economists predict, can give a buoyancy to our GDP growth. Apart from enhancing consumption, the other pillar in this budget seems to be on easing compliances. And even before the budget, the previous day we had the economic survey, and in no uncertain terms, the economic survey said one thing, that growth through deregulation. And it was very, very positive to hear that. In fact, some statements in that economic survey were music to my ears when the survey was instructing or recommending the state to get out of the way and let businesses flourish, or trust first and scrutinize later. Or very importantly, regulators should hold themselves to the same standard as they expect from regulated entities. Now, something that is very good in spirit, and this is the only way where we can grow in the hyper-competitive global economy. Through her record 8th consecutive union budget, the Honorable Finance Minister has set the stage, and we can expect that she'll break the record in terms of absolute numbers of budget as well, which is held by Mr. Chidambaram at 9 budgets and Morarji Desai at 10 budgets. Not only has the Finance Minister made the general middle class happy, but also at BCS, we are very happy with the Finance Minister. Because we could get to listen to Pinakin Bhai twice in this year, one under the interim budget and one today. And hopefully, when the new bill is out, we'll have the occasion for requesting Pinakin Bhai one more time to share his guidance with us. Once again, a warm welcome to this public lecture meeting, and may I please request Kinjal Shah to formally, informally, but introduce Pinakin Bhai, who doesn't need any introduction, and take the proceedings forwards. Once again, a warm welcome, and thank you so much.
Good evening, President Anand, Shri Pinakin Desai, past presidents of the dais and dignitaries with the esteemed BCS members. It is with immense privilege that I am here to introduce a legendary personality, Shri Pinakin Desai, who as such it needs no introduction amongst the chartered accountant fraternity. Friends, Pinakin Desai is a member of the Institute of Chartered Accountants since 1973, and his career spans esteemed firms like NM Raiji and Company and his own firm PD Desai and Company. He currently leads the Ernst & Young's Tax Knowledge and Solution Group, developing tax solutions and structures, and his commitment to education is evident as is being visiting faculty at NM College. Pinakin Desai's deep BCS connection includes serving as president in 1987-88 and chairing various committees at BCS. His dedication to knowledge sharing is exemplified by over 30 technical papers presented at various refresher courses and residential courses at BCS. His contribution extends to organizations like Indian Merchant Chamber, the Forum for Free Enterprise, and also has served as independent directors on board of various reputed companies. He was also the editor on the editorial board of ICI, and his expertise in tax law is evident in his numerous research papers presented at various national seminars and conferences. Friends, I can read on and on his introduction, which could be larger than his speech on finance bill, but I will not stand between you and Pinakin Desai. And may I now request our Honorary Secretary, Kinjal Bhuta, to come forward and present a memento to Shri Pinakin Desai. And I request all the office bearers also to join Kinjal in presenting the memento. Mandar. Friends, we will have Pinakin Desai sharing his valuable insights on the union budget, and we have this unique opportunity to learn from one of the profession's most respected figure. May I please request you to warmly welcome Shri Pinakin Desai. Sir, we eagerly await your insight on the budget. Welcome.
So good evening to each one of you, the dignitaries on the dais and all my dear friends in the audience. I was mentally made ready by the President to believe that suppose when we open the curtain and if we don't find people, this being a very light finance bill, we can certainly wind up without the speech. So relatively, it has been a light budget that we have, not only in terms of the content, but reflected also in the short duration of the speech of the finance minister. So obviously, it would be curious if my talk were to exceed the time taken by Nirmala ji, because you can't analyze something beyond what has been stated by Nirmala ji. But as we go through the fine print, as is always the case, we do find that there are changes which need discussion. It may be another thing that all the changes may not be impacting everybody, But then whoever is getting impacted needs to be careful about the changes which are made. So in that spirit, maybe we can look at 10 to a dozen different captions which need, to my mind, discussion and some comment. All comments may be regarded as provisional because as we go further and there is a spread of word amongst the people, new thoughts will come in. But for the time being, let's get to some of the changes which I believe need discussion. Let me first talk about the calibration of the tax rates. And there are possibly 2 or 3 things which you can talk when it comes to calibration. The most popular of that being that there is under new regime to be no tax on income up to 12 lakhs of rupees. On income up to 12.75 in case of salaried employee, there would be no tax. And if one is making use of NPS, then on income up to 13.40 lakhs, likely that there will be no tax payable by a person. Though it is announced that it is the middle class which benefits, and in terms of propensity or proportion, indeed, it is the middle class which will benefit the most, because on income of 24 lakhs of rupees, the tax benefit would be 1,14,000, which is relatively indeed quite substantial. But that is not to say that the changes are going to impact only the middle class. All across the board, everyone is likely to benefit, whether rich or super rich. A rich in the bracket of 50 lakhs will benefit to the extent of 1,26,000, and a super rich may still also benefit to the extent of 1,47,000. The second change that we get is on tax deduction calibrations, mainly in terms of the threshold. There was an expectation that there would be standardization of the tax deduction rates, that there could be only about 3 to 4 rates which may be applied, but probably we will have to wait for the next week in order to find out what has been done in that direction. What has happened currently has been that some of the threshold limits have been adjusted. For example, on commission payment, there may be tax withholding required if amount credited or paid is 20,000 rupees. Now that amount has been calibrated to 30,000 with no other change in the overall mechanism. But one noticeable change which we find is in respect of rent payment by non-individuals and non-HUF. When an individual or HUF makes rent payment under section 194 IB, we are told that tax is to be withheld if the amount exceeds 50,000 rupees per month. But in relation to a company making payment or LLP making payment, under section 194I, the limit was 2,40,000 on an annualized basis. In order to bring parity between the two provisions, as it looks like, we now find that even under section 194I, rent withholding will be required if the rent payment is 50,000 rupees per month or part thereof. It is now converted into not an annualized amount of 2,40,000, but a per month amount. And it could therefore arguably be a position that if a company were to take some premises for which there is rent paid in advance, say 30 lakhs is paid for 10-year period, such that per month you get less than 50,000, then even though the payment upfront may be 30 lakhs of rupees, no tax is required to be deducted, and even in the subsequent year, you find that amount credited will be less than 50,000 per month. And the last point on this caption, which requires some observation, is capital gains income and the announcement that no rebate will be allowable in respect of special rate income, the relief which is otherwise admissible under Section 87, capital A. In fact, it is the magic of Section 87A that we are able to find reduction in the tax liability of people all across. Today we find in Section 112, capital A, subsection 6, that when capital gain becomes chargeable under that section, rebate is not to be allowed. We do not have any provision in Section 111A, nor do we have a provision in Section 112, nor do we have a provision in Section 87, capital A. And a little surprise is that even though what is sought to be achieved is, rightly or wrongly, I think there is no reason why that change should be made, but assuming that they would believe and stick to an idea that special rate income has to be taxed at the special rate only, then they will need some amendment either in 87A and in 111A, 112 to deny the relief to the capital gains income. Unless that change is made, I think it may be counterproductive and it may not give the result which is desired. To repeat, I would believe one should not make that change, but if one wants to make that change, it has to be adequate enough such that the effective result is obtained. The second one which we find is a small item, self-occupied property, and deemed income in the nature of annual value of self-occupied residential house that is regarded as nil. Even today, supposing I am owning one house, then no questions asked, there is no annual value to be attributed, the income will be considered to be nil, though under Section 24, I may get suitable deduction in respect of interest. There may be a second house, and I am talking about the possession today, and that house may not have been let out. It is under my keys, so in self-occupation. But if I want to have annual value of that house to be nil, I have to give justification. I must live by the conditions which are prescribed, upon which only I find that the non-occupation can be explained. The change which has been made is that now, even with regard to the second house, regardless of what the reason is, the deemed annual value will be considered to be nil. So effectively, both the houses are to be exempted, and one does not have to statistically explain why the house is not in my occupation, even if it is a house in the very same city. That brings us to a scenario, the next caption, of taxation of charitable trust. I think last time or last two times that we discussed, we were always quite worried as to why they make unnecessary changes to the structure of taxability of charitable trust. But this time we find that there is something to rejoice. The amendments which are made are both welcome amendments. There are in all statistically 3 amendments which are made, but we will discuss only 2. The first one is the duration of the period of validity of registration which is granted to a trust. A trust, when it is registered, it is now registered for a maximum period of 5 years, whereafter I must approach once again for the purpose of renewal. We are now told that if you happen to be a small charitable trust, and a small charitable trust is one which, when it is making an application, can look behind and see the 2 preceding years. If the income of the trust during each of the 2 preceding years is 5 crore or less, including the corpus donation amount, then the trust is regarded as a small trust. In case of such a trust, the period of validity of registration will be 10 years. You may need to apply for renewal only after a period of 10 years. Now let's take a couple of examples. Supposing there has been a new trust which was created in 2022. It applied for registration in 2022. Somehow it could not commence activity. It might have collected donations, but it has not been able to commence activity. Such a trust was provisionally registered for 3 years, and it will come up for renewal in 2025. Let's assume that the trust is a small trust because in the last 2 years, income was less than 5 crore. Such a trust, when it is now granted registration, it will be granted registration for a period of 10 years instead of what otherwise would have been a period of 5 years. Whether or not trust is a small trust needs to be seen on the basis of 2 years preceding the date of application. It doesn't matter that income of the trust might exceed 5 crore of rupees in any of the years during which the registration happens to be in force. Let's take another example. It's a bit controversial, but it is something which is possible and arguable. Supposing there is a long established trust which in 2021 had to seek registration. It would have made an application for registration in 2021, and after inquiry, let us assume that registration has been granted to that trust. That registration would have been granted under section 12AB, subclause 1. And section 12AB, subclause 1 can deal only with this single situation where a past trust is getting registered in 2021. That registration is valid until 2026. The question that arises is, will that registration stand elongated to 10 years as a result of this provision if one can show that in the 2 years preceding 2021, the trust had low income and it is therefore a small trust? I would believe that it seems to be a possible argument to offer, though it would be good if CBDT clarifies it. Why I believe that it's a possible argument is that there is a reference in the amendment provision which deals with 12AB clause 1, and 12AB clause 1 will not carry any meaning unless and until this 2021 trust is regarded as covered by the new opportunity of fresh lease. The second amendment concerning the charitable trust, which is quite substantial, and that deals with the periphery of related person. Whenever a charitable trust deals with a related person, one has to be extremely careful. This is because if an amount which is spent or applied by a charitable trust in favor of a related person is more than reasonable, then there would be addition of income to that extent. 30% will be the tax payable. Penalty could be 100% in case of first default, 200% may be in case of second default. You pay a very heavy price. Let's consider that you are a hospital and a contract for cleaning or repairing or painting or laundry is given to one of the concerns which might appear to be a related party. Then this provision, you will need to test the benchmarking. In case of a school, for example, if there is purchase of books or uniform or canteen food or bus service, and there is a related concern, then this provision of benchmarking has to be applied. So the question arises how to define the related party. So one rule is, if you are author of the trust, then no matter what you do, you will throughout the life of the trust be considered as a related person. Your relative will also be considered a related person, and any concern in which you or your relative is interested substantially will also be a related person. No change is made to that scenario. Second is, if you are a trustee or a manager during a particular year of the trust, then for that year, you will be a related person. Relative is also RP, and a concern where you or relative is interested will also be regarded as a related person. Again, no change which has been made here. But supposing you are not an author, you are not a trustee, you are not a manager, but you have been giving donations to the trust, you are therefore a contributor. A contributor can also become a related person. The rule today is that if anybody has given up to 50,000 rupees in the aggregate to a trust throughout the life of the trust, so take the sum total of what all that you did from the first year, and if it exceeds 50,000 rupees, then you become a substantial contributor, your relative and your concern is covered. That is the position today. Now there is a change made, and the change is twofold. One is, if during any particular year you have given a donation or made contribution of more than 1 lakh of rupees, then for that year you will be regarded as a substantial contributor. Remember, you are not author, you are not trustee, you are not manager. The second change when you become substantial is, that if throughout the life of the trust you have in the aggregate contributed 10 lakhs of rupees, then only you will become a substantial contributor. Now, despite the fact that you become a substantial contributor by applying the revised limit, even after you become a substantial contributor, your relative will not be a substantial contributor. A concern in which you are interested or relative is interested will also not be a substantial contributor. So you will be able to make out that quite a few of the transactions compared to the position today will fall outside the arena of related party, and you will be saved of the drudgery of applying section 13 subsection 3 in relation to these transactions. The next change that we see is a small one, and that is on tax collection in respect of the LRS payments. This is a welcome change. Number one is, no change has been made in relation to the rate at which tax is to be collected. A tour operator has to collect at 20%, authorized dealer has to collect at the rate of 5%, but today we find that you have to deduct tax at source as authorized dealer if the LRS has exceeded 7 lakhs of rupees. Compared to that, effective from 1st April 25, you will find that the limit has been increased to 10 lakhs of rupees. That's a relatively small change. The second one is, when there is a remittance made for the purpose of education, and it's a funded amount, funded in the sense you borrow money from a bank or financial institution with a view to make contribution for educational purpose and make a remittance, then today there is token tax collection of 0.5%, but now it is said that you do not have to pay any TCS in relation to such remittances. It may look to be small in terms of the volume or money, but we can consider the plight of a person who has to borrow money to fund education. I think this is a welcome change. The second, when it comes to the second caption when it comes to tax collection is in respect of tax collection at the time of sale of goods. Section 206 C1H. A very curious provision that we have today. If I am supposing a buyer of goods and I am in business with a turnover of more than 10 crore of rupees, I am buying goods from you and you are a seller having turnover of more than 10 crore of rupees, and during the year I am buying goods of more than 50 lakhs from you, then number one, as a buyer of the goods, I have a tax withholding obligation, 0.1%. Under section 194Q, I am supposed to deduct tax at source at the time of credit or payment, whichever of the two is earlier. Now, normally one would visualize that if I have an obligation and I don't honor that obligation, then the consequences of default will be on me. But here was a provision, curiously, namely that if I have defaulted in deducting tax at the time of crediting your account, then Eventually, when I make payment to you, at the time of receipt of money, you are under obligation to collect the tax which I failed to deduct. So, both the parties on an alternative basis were regarded as liable to this provision. The change which has now been made is that whatever was my obligation as a buyer continues, there is no change. But effective from 1st April 25, as a seller, you will not have an obligation of TCS. Supposing there is some purchase which I made in March 25, for which I have not made payment, I have defaulted in deducting tax, I will suffer consequences. But if remittance which you received in respect thereof falls beyond March 25, then you will still not have TCS obligation, though it relates to a transaction completed before March 25. This brings us to a very significant amendment, and to the corporate sector, it might affect substantially, and that is migration of business losses on amalgamation. No changes made in respect of migration of depreciation. Changes are made in relation to migration of business losses. Let's assume that I am a company doing business, and in the course of business, I have incurred losses. Then, if I am not able to set off the losses against any other income during the year, I am permitted to carry forward the losses. Carry forward cannot be beyond 8 assessment years from the assessment year in which loss is computed by the assessing authority. If there is unabsorbed depreciation, I can carry it indefinitely. But if it is business loss, then in that case, I can carry forward only for a period of 8 years in the maximum. Now, while an assessee can carry forward loss in his own hands, he is, as a general rule, not permitted to transfer the losses to another person. You require authority at law to transition or transfer losses to some other person. So there are 3 situations in which there is a statutory permission that you can transfer the losses. Number 1, when one company amalgamates with another and the conditions are fulfilled, then the loss can be transferred to another company. When a proprietor or a partnership firm is converted into a company and the conditions are fulfilled, loss can be transferred. And the third is when a company is converted to LLP as per section 4714, then also the loss can be transferred. If I don't transfer, let's recollect, losses will lapse 8 years from the end of the year where I incur losses. Now let's suppose that a company has transferred the loss to another company. Then today what is happening is that if I incur loss for say 6 years, I know that now the loss is about to lapse. First year loss will lapse in year 9, second will lapse in 10, so gradually the loss will lapse. So what I do after 6 years, that I amalgamate with another company, me being A Limited, we amalgamate with B Limited, then unabsorbed losses in my hands become loss of B Limited as if B Limited incurred those losses in the year of amalgamation. In the year in which amalgamation is effected is what the provision says. And the courts had said that we need to go by concept of appointed date for finding out when the amalgamation is effected, which is the provision today. So it becomes loss of B Limited in the 7th year, and thereafter B Limited can carry forward for another 8 years. This was known as evergreening of the losses. This was not required for a demerger, because in demerger anyway, you can carry forward such that you can carry forward only for the residual period, whereas in case of merger, you could carry forward once again for a period of 8 years. In order to prevent this evergreening of the losses, to prevent that the losses always remain live, because there could be A to B, B to C, so perpetual evergreening, to stop that, we are now told that when there is an amalgamation, loss will become loss in the year of amalgamation, and the company therefore which is incurring the loss, that is B Limited, is deemed to incur that loss. So that part of the fiction continues, and B Limited can set off those losses. But if B Limited has to carry forward the loss, then B Limited can so carry forward the loss that from the year of loss incurred in the entire chain, they are not able to carry forward in the aggregate beyond 8 years. Let us try to take some illustrations to make this concept clear. Supposing A Limited is incorporated in 2018 and it has consistently incurred losses. In 2024, A Limited amalgamates with B Limited. Now here the amalgamation appointed date is prior to 1st April 25. Such being the case, amendment does not apply. The old law applies, and B Limited can carry forward for 8 years, despite the fact that 6 years had already gone by. This is not a scenario which is affected by the change. Second illustration, A Limited incorporated in 2018, consistently incurring losses. There is amalgamation in 2025. New provision applies. So what will happen is that in 2025, whatever is the profit which B Limited has, B Limited can set off against the losses which are inherited. But when it comes to carry forward, assume as if the amalgamation is never effected, and together with the period consumed by A Limited, loss can't be carried forward beyond 8 years. Consistently year by year, 1 year's loss will keep on lapsing in the hands of B Limited. Take a third scenario. A Limited was incorporated in 2014. It ran for 6 years until in 2020 there is amalgamation with B Limited. As per old law, because 2020 falls in the old law period, 2020 loss inherited could have been carried forward for another 8 years. But B Limited now amalgamates with C Limited in 2025. Second amalgamation is effected by the new law. What will be the right of C Limited to carry forward the losses not only of A Limited but also of B Limited. And the rule will be that C Limited will have to ask a question that A Limited 2014 loss, could A Limited have carried forward if there was no amalgamation? And if the answer is no, C Limited also cannot carry forward. So consistently from the year of incurrence of loss till the 8-year period, even C Limited will lose a claim with regard to A Limited loss as also with regard to B Limited loss. Gradually, one by one, year by year. Now the last illustration which we take, and this can be prone to two interpretation, but let's assume same facts. A Limited incurs losses for 6 years, amalgamation with B Limited in 2020, losses by B Limited, then you go to C Limited in 2026, and the profit earned by C Limited in 2026 is so huge that it can absorb all the accumulated losses in 2026 itself. Now, how will this provision operate? And here it is arguable that the restriction is with regard to the carry forward, the right to carry forward of C Limited. There is no restriction raised with regard to right to set off in the year of amalgamation. So it is possible that in 2026, all the losses can be set off by C Limited, including losses incurred by A Limited in 2014. I am not sure whether this is intended or not, but this appears to be a plausible result. And here, 72A1, notwithstanding non-obstance clause, might be of some help in interpretation. Now, moving further on the corporate sector, we come to the presumptive tax in case of non-residents who are giving service or technology to the units which are engaged in manufacture of electronic goods. The government is quite conscious that electronics is the future, and people who have to depend on silicon technology and turn out the electronic goods are treated with a red carpet by the government. There is a scheme of the government, as we know by name MITI, according to which if an Indian company is set up for the purpose of manufacturing specified products, and they could be, supposing the chips or the wafers or maybe the memory devices which are produced either for the solar panel or maybe for the mobiles or LCDs, etc., then the government funds up to 50% of the project cost. The project cost itself has to be, in some cases, at least 10,000 crore, and the government is funding 50% of that. Now, it is in such cases that this provision will apply. What we are told is that if a non-resident gives some service or technology in India to an Indian company which is registered under MITI, it's not your choice to avail of this benefit. You must first be registered under MITI as per the conditions laid down there. Then service or technology to such units, you will find, will be taxed at concessional rate under domestic law in the hands of a non-resident. If a non-resident receives 100 rupees for technology, royalty, or for services, services need not be technical services, any service including technical service. Then out of 100 rupees, 25 rupees will be deemed to be income, and the tax payable thereon at the foreign company rate will work out to 9.56% or so. So less than 10% of the tax is what we are looking at. Now this is a provision which is welcome, because any benefit which is given to a supplier of service or technology is going to help an Indian company negotiate the price at which the service or technology is bought. There are some aspects, some of which seem to be so obvious that possibly they will be corrected. But number one is that a service could be offshore or it could be onshore. All the services are covered. They need not be technical service. So in relation to offshore service, a non-resident covered by the treaty will probably go to the treaty if it is not a technical service. Second, assuming that there is a service provided or there is technology, but per chance if that foreign company is triggering a permanent establishment, then we will need to see that read with section 44DA and 115A, the section should stand protected. Some backup amendment will be needed in order to ensure that neither 115A nor 44DA will conflict with any of the provisions of this section. There is a small drafting error, as it seems, that the presumptive income is sum total of, with the conjunction and, sum total of what I pay and what you receive. So if I am paying 100 rupees, you are receiving 100 rupees. So as per the draft as we have, unlike in case of section 44B and BB, the consideration chargeable to tax comes to 200, because I paid 100 plus you received 100 is what is the measure of consideration. An obvious drafting error, but good if it is corrected along the lines of section 44B and section 44BB. The next one that we take up is with regard to penalties. The time limit for the purpose of completing penalty orders, when we find that it is an assessment related, say for example, colloquially as we say, the concealment income penalty. Typically what happens is that if in my case, assessing officer has passed an order, I go in appeal, from CIT appeal travels to tribunal. Normally penalties are kept in abeyance in most cases until the stage of disposal of appeal by the tribunal. Now, in the month in which tribunal passes the order, hopefully the order comes to the assessing officer, and he is supposed to pass a penalty order within 6 months from the month in which he receives the order from the tribunal and the proceedings are completed. There is a small change made there, namely, now he will pass an order within 6 months from the quarter in which the order is received from the tribunal, the proceedings are completed. This will mean some small elongation in the time available for the purpose of completing the penalty order. Now, there is only one case in which we find that this section, when amended, will create a chaos for the department. While in almost all cases, penalty orders are to be passed within 6 months from the month of completion, there is one case in which penalty order is required to be passed within 1 financial year from the financial year in which the proceedings are completed. Supposing in my case, appeal has gone to CIT appeal, order is received in April 24, and thereafter I don't file an appeal to the tribunal. Proceedings are completed at the stage of CIT appeal. As per the present law, CIT appeal order coming to the officer, AO has to complete the penalty within 1 financial year from the end of financial year in which he receives the completion of proceedings order. He needs to pass an order by March 26. But now the new provision is he has to pass an order within 6 months from the quarter in which the proceedings are completed. So the new time limit will be December 24. From March 26, we are shifting to December 24. So when a new provision comes into effect on 1st April 25, will the taxpayer be able to urge that you no more can pass an order because it already got time barred in December 24? This is a likely area of dispute, and instead of litigating on general principles of law, it would be good if a suitable correction is made by the draftsman at this stage itself. Now, this is what we talked about assessment-related penalty orders. But there can be penalty orders which do not relate to assessment. For example, the tax withholding default, or I have taken cash loans and penalty is to be levied under 269 SS. What are the time limits in relation to such penalty order? Now here we are told that the penalty is to be completed within 6 months from the date on which action to levy penalty has been taken by the tax authority. And a very curious situation used to arise here where there is litigation in the fold. Today such penalty can be levied only by JCIT, whereas my assessment would be completed by an assessing officer. So typically what used to happen is that in the course of assessment, the assessing officer will notice the default and he will write to the JCIT that so-and-so default has been noticed by me, kindly do the needful. After some months, JCIT will issue the so-cause notice, and thereafter there would be a hearing which is concluded. Now when it comes to the time limit, the law says that it has to be 6 months from the month in which action has been taken. And litigation used to arise on the point, action means what? assessing officer writing to the JCIT, was it an action? Or action commences only when JCIT issues the show cause notice. And some courts had taken a view that the very first step, the month in which officer wrote to the JCIT, is the month in which action has been taken. Live with the time limit in accordance with that prior date and not from the date of show cause notice. To take care of it, now it is provided, it is 6 months from the month in which the show cause notice is issued. This is change number 1. The change number 2 here, and which is likely to raise again issues of relevance, is that now we are told that such penalties will not be passed by JCIT, but penalties will be passed by assessing officer, but subject to the approval of JCIT. Now, effective from 1st April 25, jurisdiction is not with JCIT, but the jurisdiction is shifting to the assessing officer. Show cause notices might have been issued by JCIT, or the records are pending with the JCIT. They now come back to the assessing officer. There is no saving clause which is provided, and a question therefore will arise: is it that old orders have to be passed by JCIT only, or is it that the JCIT loses jurisdiction? Now, a better view of the matter seems to be that on the basis of the show cause notice issued by JCIT, the pending proceedings will come back to the assessing officer. JCIT cannot pass an order. It has to go to the assessing officer. No new show cause notice to be issued by the assessing officer, but possibly he will be under compulsion to issue a notice of hearing to give a fresh opportunity of being heard to the SCC. But for that, quite possible that he passing an order based on the records may or may not carry conviction with the higher authorities. The next important change affecting the corporates in general is in the transfer pricing scenario. And I would wish it should have been Mr. Ostwal talking to you on this. A very well-meaning provision, but I am not sure whether the provision would fly because it is subject to ifs and buts which need to be resolved. But it's an experiment, and let us see whether we will be able to make use of it. We are aware of the transfer pricing scenario, that if I am a company having transactions with my associated enterprises, then I have to establish the arm's length price. I furnish my return to the assessing officer, and if the AO believes that it is necessary and expedient to verify the ALP, then he will refer the matter to the transfer pricing officer and he will fix the ALP for me. Same type of transactions may recur every year, and every year, as a matter of repetition, the officer may send it to the TPO, and the TPO will give the ALP back to the AO to be adopted by the AO. So the thought now is that instead of repeating the exercise every year, why not develop a concept of a block of 3 years where the ALP or the methodology of ALP, which has been settled by the transfer pricing officer in year 1, will be regarded as binding on the SSC. Now, if I am comfortable doing this, at my option, either when the TP assessment is continuing or after the TP assessment has been concluded, which one will be adopted by the tax authority, we don't know, because the form, manner and time limit are yet to be prescribed. So as an SEC, I go back to TPO and say that in year 2 and 3 also, I am likely to have similar transactions, and I would therefore submit that I will be bound by whatever that you decide in year 1. If he verifies the thing, and we don't know what he will verify, but mostly I think he will verify whether my likely transactions are similar to transactions in year 1. Today in the explanatory memorandum, the indication is that transaction is similar only when either the transaction is with the same associated enterprise or with another associated enterprise but in the same country, or that proportionately looks like volume of transaction is small, then this provision will file. What they have explained is not very clear, but this is what probably they want to convey. In his own way, the TPO may also try to verify whether the transaction is similar or not. Now, if he is agreeable, then he will accept my request and this particular provision will fly. If I have dispute on ALP determination in year 1, I will go in appeal in year 1, and whatever is the outcome of year 1 will be binding on me in year 2 and year 3 as well. I think it may be either on determination of a figure, absolute figure of ALP, or it should also fly when a methodology has been settled by the TPO. For example, 8% of so and so base, the figure may change, but the methodology may be the same. Now, very unlikely that this will fly. People are always worried how long it will take to convince the TPO. He will virtually conduct my transfer pricing assessment before he accepts that request. It's another thing that for APA such a concept is flying. After 2 years, you may come back and say that no, sorry, transactions were not similar. People are unlikely to take that chance, but much will depend on what are the rules prescribed in this behalf. Moving further, we go to a provision which deals with the updated return. Suppose in a given year, I have omitted to file the return. I have not yet filed the return. Notice 142 notice has not yet been received by me. Or I have filed the return, but it has not yet been picked up for an assessment. I noticed certain omissions. It might have been intentional omission also. I had concealed my income at that point of time, but now there is a change of heart, or it could be an error, it could be omission, and I want to come clean. So I have facility of an updated return. Today what I am told is that except in case of a surge or default like Black Money Act default or the Smuggling Act default or whatever, but by and large, in normal cases, what I am told is that if I file updated return within 1 year from the end of assessment year, it's not a revised return. In revised return, I have to explain that there has been a bona fide error. Here, no questions to be asked. I can even make up for, as I said, a conscious earlier default. If it is within 1 year from the end of assessment year, I have to pay incremental tax, incremental interest on incremental tax, plus 25% of the aggregate of incremental tax and interest. If I do it after 1 year, but before 2 years, and that is all that I can do today, then I pay incremental tax, incremental interest, and 50% of the aggregate of tax and interest incremental. We are now moving further to say it could be end of 3rd year, it could be end of 4th year. But the additional tax figure for 3rd year would be 60% and 4th year would be 70%. I think sense-wise it is a good provision to buy peace instead of maybe conducting a search or a survey. If somebody comes forward and he believes that he is likely to be caught, but he comes up, there is litigation point, judiciary has settled a point, and I go back to buy peace, it's a good provision. But in the 3rd or 4th year, the price seems to be a little bit exorbitant. Consider that in a block assessment, after the search and I am caught and I am offering the income, in the return I am told 60% amount is fine. And here if you calculate, I have come voluntarily, and yet you will either levy 60% tax or more than 60%. People will compare, let me wait for a search, rather than filing an updated return. But on an overall basis, as a concept, I think it's a good concept. This brings us to an amendment which, though applicable only to the shipping sector, is a highly welcome amendment. The tonnage tax scheme, it has now been enlarged to cover more number of taxpayers. Shipping sector is marked as an infrastructure so that you are able to get loans cheaply, and the debt equity ratio also is on the basis as if it's an infra project. The government wants to encourage the shipping sector, and therefore there is a tonnage tax scheme which is already on the statute book today. Shipping companies find that scheme to be quite attractive because in most cases, income which is determined is lower than the commercial income of a shipping company. There is also an advantage that it has to be adopted at my option, and if I am having a fleet of 10 ships, I can ascertain that for 5 which are qualifying, I go in for TTS, and for the balance 5, I will go by the normal provisions of law. Currently, it is in respect of the sea-going vessels registered under the Merchant Shipping Act that this scheme can fly. If you are not a sea going vessel operator, then you do not qualify. Now the intention is that, including in respect of the ships which you might be already possessing, you can go for the inland water ships as well. Under the Merchant Shipping Act, sea-going vessels can be registered only if they are mechanically propelled. But now, in relation to the inland water, you can use the scheme for all the vessels which are registered under the Indian Vessel Act. They might be mechanically propelled or they might not be mechanically propelled. Now, what would get covered here would be, number one, the barges and the tugs which are being used to create a breach between the port and the ship is likely to be covered here. There is a congestion at most of the ports. The big ships are therefore kept away, and the tugs and the barges will be used for the purpose of taking cargo to and fro. So these barge operators are covered by the Indian Vessel Act, and they can opt for the TTS scheme. Second, the vision of the government is also to develop the inland waterway, and all those ships which are engaged in the Indian waterway will be covered. There is a proposal also to run the cruise, and very likely those will also get covered by these provisions. There are some exclusions, but exclusions do not appear to be very relevant to us. Let's concentrate on what can qualify. So it's increasing the canvas compared to the canvas that we have today, and this we can consider as a welcome provision. That takes us, as we go to the end of where we are, to the search proceedings and the undisclosed income. We discussed this last time, if we remember, and we left behind a number of ambiguities. With a view to resolving the ambiguities, we find that the provisions have been reframed. It's not as if that the ambiguities get solved as a result, but certainly the number of ambiguities is getting now reduced. Let's assume that there is a search on me in January 25. So there is a broken period from last March until January 25. And I omitted to file my return for the last year. I am still compiling the data, and there has been a default in furnishing the return of income. There was a doubt whether in respect of the last year, where my books are complete, where my audit is complete, but my return has not been filed, will that be regarded as undisclosed income? And both the past law as also the current law seems to affirm the legislative thinking that this income will be regarded as undisclosed income, though logically so said, it is disclosed income, no intention to conceal it, but still you find that this will be undisclosed income. But supposing if the search is in June 24 and there is a broken period of 3 months, the return of income has not yet become due, but income is recorded, invoices are sent, documents are made. In the regular course, GST would have been paid. would my 23-24 income be regarded as undisclosed? There was an element of doubt when we last discussed, but it is now made clear that this is not undisclosed income. It will be governed by normal provisions and not by the block assessment. The third item, which was ambiguous and which continues to be ambiguous, is that in relation to my past open assessments or initiated reassessment, there are some additions which are made, which are either routine additions or which are based on legal claims. Will that additional amount be considered as undisclosed income? Logically, it should not. Fairly, it should not. But when we go to the fine print, it continues to be an ambiguous area. It was ambiguous and it still continues to be ambiguous. So the lesson is probably whatever that you can settle, try to keep it clean instead of pursuing litigation might be the way probably the legislature looks at it. That may take us to the last of the discussion point for today. The amendment which has been made, again in the TDS and the TCS section. Small it is, but welcome it is. It was affecting those very badly if you were caught within the provision. Today we have a provision which is to be deleted from 1st April 25. The provision is that if I am making payment to somebody and that somebody is a defaulter in the furnishing of return of income, I have to deduct tax at source, but you are a person who for the last 2 years have not filed the return of income. Now in such a case, government wants to punish you through me. And I am told that when I make payment to you, I must deduct tax at double the rate at which I would otherwise have deducted tax while making payment to you. So through me, your money is to be retained because I will deduct tax at source. Now there was difficulty in my finding out whether or not you are a defaulter. The government website also was not able to keep pace with the list of the defaulters. And in any case, it was an unnecessary burden on me. So we are now told that the provision may be deleted. The provision deleted, yes, but there is no saving clause. I'm sorry. So does it mean that the past defaults will be condoned? I think no. All the defaults up to March 25, I will remain accountable even after March 25, but only in relation to credits and payments which are after March 25 that I need not follow this particular provision. So we come to the close of one of the lightest finance bills that we have. The President has already indicated to me in private that this could probably be one of the last lectures which we can have on the annual budget. The law is going to be so simplified next week that he believes we will not need any more public lecture. Thank you so very much.
Thank you, Pinakin Bhai. Before I formally thank Pinakin Bhai for his wonderful session, I have a couple of things to do. So may I first request Anand to kindly present the photo frame that we generally give as a memory of this session to Pinakin Bhai. May I also request other OBs on the stage to join them. Friends, we have this union budget publication for Finance Bill 2025. This is the 32nd year of publication. And this booklet, along with various other publications of the BCS, is available for sale on the ground floor. So those interested can certainly take benefit of that particular stall. Like this publication has got direct tax proposals bifurcated into 12, a dozen chapters. I have given a task to make an announcement of around 12 programs that BCAS has organized in the next few months. So I'll take a couple of minutes to just make you aware about those programs. Our next lecture meeting would be on indirect tax proposals. That will be conducted on 12th February 6:15 to 7:45, will be a virtual by CA Sunil Gawawala. We have 3 residential refresher courses announced. The first one being residential study course on Ind AS, which will be held from 20th March to 22nd March. This will be in Lonavala. The second residential course is International Tax and Finance Conference. This will be held 3rd April to 6th April. This will be at Jaipur. And the third residential refresher course will be on GST. This will be held from 12th June to 15th June on Kolkata. We also have 2 study circles in the next few months. The next study circle will be on 13th February. This will be on REIT and INVIT as investment avenues. We also have a very unique workshop, that is Writers Workshop, Crafting Words and Creating Impact, which will be held, it is a full day event, which will be held on 20th February 2025. We have another very interesting study circle as to how to read and analyze annual report. So study circles are open for all. This will be held on 7th March 2025. We have our CA annual day event Tarang, which will be held on Saturday 22nd February 2025. We also have another event called CAMBA, a certified management program for CAs, which we conduct in association with Atlas Skill Tech University. This will be held from 11th April to 13th April. These are the announcements. Now I come to a very formal task of formally thanking Pinakin Bhai. Friends, like every year, today we have gathered here to listen to Pinakin Bhai on his insightful address on the direct tax provisions of Budget 2025. This is a most awaited lecture for BCS as well as for all those audiences who are eagerly waiting for it. This is not a live streaming. We generally upload this particular lecture in less than 12 hours on the YouTube, but still we are getting a lot of requests to keep this particular session live. So that itself shows how eagerly people are awaiting. Last time when we had uploaded, in the first few hours, we got more than 4,000 views on this. This is just on YouTube. There are other social medias also where we are getting this encouraging response. Pinakin Bhai, just as the Mahakumbha Sthan holds immense significance for million devotees cleansing their souls and renewing their spiritual journey, your lecture provides us with a deep and purifying understanding at the intricacies of changes in our tax systems in a very simple way. Your knowledge and experience, the way you have pointed out certain likely areas of disputes requiring probably drafting certain clarifications by the CBDT or drafting certain amendments, or for that matter, certain drafting errors that you have pointed out, all this have converged to provide us with a holistic view of this new tax provisions, and I am sure we all will leave this session with a refreshful understanding of the new perspective as to how these changes are going to impact the taxpayers, albeit for the very short time till we get the new provisions in place. So I thank you a lot, and I request all of you to carry a very loud applause. May I also request the past presidents of BCS to come on stage so that we can have a photograph here. Thank you.